Good afternoon, everybody, and thank you for coming. Now, markets can remain irrational longer than you can remain solvent. Now, there's some historical question regarding who the author of this saying truly was, but it's generally attributed to John Maynard Keynes. By the way, can everybody hear me okay? A little louder. Let's see. Is that any better? Okay. Now, during his tenure as the chairman of the Federal Reserve, Alan Greenspan testified many times before various committees of Congress. In front of the Joint Economic Committee, Greenspan noted that markets are driven by human psychology and waves of optimism and pessimism. Now, Bernard Baruch, an exceptionally successful American financier and stock market speculator who lived from 1870 to 1965, identified the following long ago. All economic movements, by their very nature, are motivated by crowd psychology. Without due recognition of crowd thinking, our theories of economics leave much to be desired. It's always seemed to me that the periodic madness which afflicts mankind must reflect some deeply rooted trait in human nature, a trait akin to the force that motivates the migration of birds or the rush of lemmings to the sea. It's a force wholly impalpable, yet knowledge of it is necessary to right judgments on passing events. Greenspan and Keynes are among the most well-known economists in American history, and Baruch, as noted, was an exceptionally successful businessman. All three have come to realize that markets are driven by emotion and human psychology more so than fundamentals, as most believe them to be. In fact, how often have you heard pundits say the market is simply not trading based upon fundamentals at this time? Now, as these gentlemen have noted, one needs to understand human psychology in order to be able to more accurately navigate our financial markets. So back in the 1930s, an accountant named Ralph Nelson Elliott identified behavioral patterns within the stock market which represented the larger collective behavioral patterns of society en masse. And in 1940, Elliott publicly tied these movements of human behavior to the natural law represented through Fibonacci mathematics. Now, the full theoretical basis for what we now apply as the Elliott Wave principle has been fully developed and publicized. Elliott theorized that public sentiment and mass psychology move in 5 waves within a primary trend and 3 waves within a counter trend. Once a 5-wave move in public sentiment has completed, then it's time for the subconscious sentiment of the public to shift in the opposite direction. And this is simply the natural cycle within the human psyche and not the operative effect of some form of news. Now, this mass form of progression and regression that we see in life and our markets seems to be hardwired deep within the psyche of all living creatures. And that's what we've come to know today as the herding principle. And this gives this Elliott Wave theory its ultimate power. Now, over the last 30 years, there have been many social experiments that have been conducted throughout the world which have provided scientific evidence and proof to support Elliott's theories presented almost a century ago. Today, I'm going to be presenting you my thoughts on the future of the equity and metals markets based upon this theory. Now, if there was anyone in attendance here that attended my presentations in 2016 at the Traders Convention in New York, you were likely taken aback by my expectation that the equity markets were about to start a massive multi-year rally. In fact, for those that may remember, I was expecting a strong rally from the 1800 region to 2611 in the S&P 500 with targets of 2800 to 3000 thereafter. But the most common reason which many who attended that presentation voiced, along with those who commented on my public articles, was that the fundamentals simply did not support such a conclusion back in 2015 and 2016. At the end of the day, they were all quite certain that this was just not going to happen. Bear with me one moment. So before I go into my current expectations in the U.S. equity markets, allow me to digress for a moment and address the common thought process of most in the market and why they're often wrong at the major market turns. In an article written by Carolyn Baum in Bloomberg entitled "Rear View Mirror is Where Economists See the Future," she termed a forecast based upon fundamentals as a hindcast. And I think that pretty much says it all. Within that same article that she wrote, she quotes Bob Barbera, chief economist at Mount St. Lucas Management Company, as saying, allowing the pace of economic growth in the last 3 to 6 months to dictate the next 3 to 6 months beats most forecasts, except when it matters. That's an amazing statement if you take the time to think about that. If you can really understand what the author is saying when he said that. It means that using backward-looking information, in other words, using fundamentals to attempt to forecast the future, only works within a trend. It will never be able to identify a trend change. In other words, when it matters. Now, ultimately, this suggests that following fundamentals is no different than following a trend channel. As long as the trend continues, the fundamentals will seemingly be aligned with the general market. But once the price trend ends, the fundamentals are usually still entrenched in the prior trend for quite some time. In fact, in a 1988 study conducted by Cutler, Poterba, and Summers entitled "What Moves Stock Prices?" they reviewed stock market price action after major economic or other type of news events, including major political events, in order to develop a model through which one would be able to predict market moves retrospectively. Yes, you heard me right. They were not even at the stage yet of developing a prospective prediction model. However, the study concluded that macroeconomic news bearing on fundamental values explains only about 1/5 of the movement in stock market prices. They even noted that many of the largest market movements in recent history have occurred on days when there was no major news events. They also concluded that there is surprisingly small effect from big news of political developments and international events. Isaac Asimov once said that your assumptions are your windows on the world. Scrub them off every once in a while, or the light won't come in. So maybe it's time for us to scrub our assumptions about how markets really work. Now, allow me to present to you a basic list of all the fundamental reasons as to why most maintain their assumptions that the market was not supposed to attain the targets we set years ago. As you can see, the list is quite large, and there are still many that I've even left off. So I have a question for all those that have been looking for the elusive stock market crash over the last, I don't know how many years, as the market continued to rally. Does any of the price reality of the market over the last 10 years make you question your thesis about news, fundamentals, or real-world dynamics controlling the market? Well, if you're being honest about seeing a massive rally after the 2016 elections, when the common belief was otherwise, you should be. If you see the markets rally quite strongly after a massive terrorist attack, you should be. And when you see the metals tank in 2013 after quantitative easing 3 was effected, When the common fundamental expectation was exactly the opposite, you should be. But no matter how many times investors see evidence that the market is not as mechanical as they believe, they simply shrug it off, claiming that the stock market is just not trading based upon fundamentals at this time. The question one has to ask themselves is, if the market continually does not make sense based upon fundamentals, why would you not change your premise to something that consistently does make sense? Now, lastly, consider a recent study of 2,600 investment recommendations by technicians and fundamentalists. The conclusion of the study stated, and I quote, "Technicians display stock-picking skills while fundamentals reveal no value." So let's again take a look at the 2016 chart of the S&P 500 we presented to our members back in 2016. As you can see, what we were looking for was a major breakout and continuation rally that should last several years. That was going to take us, our minimum target for this was about 2,600 on the S&P 500. So let's take a look at where we are today. As you can see, once we started the main rally, we usually use these blue boxes for targets. So as you can see, we came up just shy of my target box for that rally we were expecting to begin in early 2016. And since then, we've pulled back. Now, where do I believe the market is going to be headed? Well, my bigger target at this point in time is actually further down than up. Can we still rally to 3,000? It's possible. It's definitely possible. I'm not seeing anything that is telling me at this moment that it is highly likely. My larger degree perspective right now is I believe we're about to see a major correction, not necessarily bear market, but that's going to also depend on how you term what a bear market is. But I'm looking for the 2,200 level on the S&P 500 over the next year or two. How long it'll take, I can't tell you. I'm an analyst, not a prophet. But what I can tell you is the longer-term expectation, as you can see from the chart that I've laid out here, this chart has been keeping us on the right side of the market now for many years. And while we did come up, I think it was about 70 points shy of our ideal target we set years ago for this part of the rally, this chart is suggesting now that we should be looking lower, much more so than higher. At this point in time, actually, if for any of you that actually read my analysis that we put out publicly every now and then, once we broke down below 2880 on the S&P 500, that opened up the trap door. And it opened up the potential for us to drop down, as we wrote, down to the 2,600 level. Let me actually move into the daily chart so you can see a little bit better. Once we broke down below that 2880 level, that opened the door to the lower target box we had on this daily chart, which began at about 2,600. And as you now know, we hit a low of 2,603, and then we began a rally. Our view right now, and we're not seeing anything yet to dissuade us from that view, but as it stands right now, we expect this rally will terminate sometime over the next few weeks, and then drop us back down to retest the 2,500 region in general, somewhere between 2,480 and about 2,550. That's what we're looking for an initial decline after this rally completes. Now, as I said, is there some possibility that we can still push higher to 3,000? The answer is absolutely. But I think, as you can see from the charts we've been following all these years, we think there is much more risk to the downside than there is reward at this point to the upside. And we don't see that the risks certainly outweigh the reward that we're seeing at this point in time about the overall S&P 500 structure. So let's move on to the metals market. And I'll take questions at the end. We should have some time for questions if you have any. Now, when we look back at 2011, and we go back and read all the articles being published back then, it stands out quite clearly, and for those of you that may remember, how bullish 99% of the market was at the time. And of course, much of it was based upon the fundamentals for gold at the time. In fact, one would have to search long and hard to find analysts who did not believe that it was a certainty that gold would eclipse the 2000 mark at the time. The analyst community really got this one wrong. But back in 2011, very few saw the top coming in the metals market. Our analysts at Elliott Wave Trader were warning investors at the time to exit the market, though, and for aggressive traders to even consider shorting. Even though most analysts and most market participants were quite certain that the 2000 mark was in the bag. But as we said in August of 2011, which is about a month before the top, since we're most probably in the final stages of this parabolic fifth wave blow-off top, I would seriously consider anything approaching the 1915 level to be a potential target for a top at this time. So as you can see, identifying the extreme in sentiment based upon our Elliott Wave analysis performed better than fundamentals in the gold market as well. Now, 4 years later, on December 30th, 2015, after gold had topped within $6 of our target that we set, we urged investors to begin moving back into the metals complex, as we were looking for a long-term bottom to be struck imminently due to the significant bearishness evident in the market. We specifically said, as we move into 2016, I believe there is a greater than 80% probability that we finally see a long-term bottom formed in the metals and miners, and the long-term bull market resumes. Those that followed our advice in 2011 and moved out of this market for the correction we expected are now moving back into this market as we approach the long-term bottom. In 2011, before gold even topped, we set our ideal target for this correction in the 700 to 1,000 region in gold. We are now reaching our ideal target region, and the pattern we have developed over the last 4 years is just about complete. For those interested in my advice, I would highly suggest you start moving back into this market with your long-term money. Days later, and in weeks later, I think we all remember what happened in early 2016 to the gold market and the miners. It just went into a parabolic phase straight up. So clearly we caught that bottom, and we began one of the strongest rallies seen in metals market history. So let's take a look at the gold chart, see what it looks like right now, and I'm using specifically the GLD. Again, we work in probabilities, not certainties. Markets are nonlinear. Therefore, there's no way we can state anything when it comes to financial markets with any degree of certainty. Rather, we work on probabilities. From a probabilistic perspective, we believe that there's still going to be one more push lower in the overall metals complex before a long-term bottom is struck. Is it possible we've already bottomed? It certainly is. And should the market break through that resistance box that I have up there, it does open that door. Specifically, that resistance box tops at 118.25, I believe, on the GLD. And in GDX, 22 was our upper resistance point. As long as the market holds below these resistances, we are looking for one further decline before the complex reaches its next bottoming stage, which is a higher bottom than the one struck at the end of 2015. And then we expect a very strong rally, which would rival the rally we experienced in early 2016 to begin. So one of our more astute members at Elliott Wave Trader in our community once noted that the goal of Elliott Wave analysis is to analyze sentiment and not participate in it. So maybe it's time we all begin to understand a bit more about what truly drives the market all the time, And that's market psychology and mass sentiment. If we do, then we can begin to rise above the masses, especially at the most critical times of impending market change. In other words, when it matters. So I want to thank you for attending, and I'm going to open up the floor to questions now. Yes?
Okay, in terms of the grand whatever, do you see an ultimate high for the market?
That is a very loaded question, the fear for our country. This is how I view the long-term super cycle that you're referring to. After we finish this correction that I believe is going to have a minimum target of about 2,200, my expectation is for a rally minimally from there to 3,225, minimally. The potential exists, we can go up as high as 4,011 or so. But a lot will depend on the structure of how we begin that rally, and that will help us be able to project where that ultimate top will be for that larger degree wave 3. Now, for those of you that are looking at the larger structure on this, the wave 3 top, the large Roman numeral 3 on top, and the large Roman numeral 4 on the bottom, are the same wave degrees that relate to the Great Depression. Meaning, if Elliott's structure is a 5-wave structure, 1, 2, 3, 4, and 5, waves 2 and 4 are corrective in nature, pullback in nature. 1, 3, and 5 continue to move up. The wave 2 of that degree was the Great Depression. So we're looking for a 4 that will rival the degree of the Great Depression. What will happen to the United States? What will happen in the rest of the world? Again, I'm an analyst. I'm not a prophet. I can't tell you what the new cycle will be. What I can tell you is that throughout history, Bob Prechter did some studies on this. Throughout history, the C wave, the bottom of the C wave of these larger degree cycles, meaning as that wave 4 is concluding, that is often the time you see major wars break out. Does that mean one's going to happen? Am I going to stand up here and tell you World War III is going to be breaking out when this 4th wave ends? I'm not telling you that. I'm telling you that sentiment can be ripe for such worldwide turmoil. But I'm not saying that is going to happen. It is part of a bigger wave. We believe man progresses throughout time, but does have periods of regression. That's why the stock market is so much higher today than it was 100 years ago. So we're always progressing. Mankind is always on a path of progression. But we do have periods of regression, and they can be quite painful. So that's, yes, ma'am. Absolutely. Every time frame. You name it, here we go. This is something we call, if you look a little more closely, you'll see waves 1 through 5 have Fibonacci extensions that are applied within the structure. And if you see, every single part of this structure is related to a specific Fibonacci extension during the impulsive structure higher. We've developed something called Fibonacci Pinball that frames the Elliott wave, the traditional Elliott wave structure, in a much more objective fashion than anybody else that uses Elliott wave out there. It frames it in such a way that it gives us advance warning about a potential invalidation well before it does occur. And it also gives us validation as we move through our progression. This is what kept us solidly bullish in 2016. So we apply Fibonacci mathematics even more so than most Elliottians, where most Elliottians will say, well, this wave 3 is going to hit this structure. Within our substructures, we have much more defined parameters within what we call a Fibonacci pinball progression. So it frames the traditional Elliott wave analysis within a much more objective fashion, utilizing Fibonacci mathematics. Depends. I mean, a lot depends on how aggressive somebody is. People who are more conservative would wait for the wave 2 of 3. Why? Because you now have your full 5 waves off a major turning point low. That's the Roman numeral 1 all the way on the left. You then wait for the wave 2 pullback. After the wave 2 pullback, you're going to start the big 3. Wave 3 itself has to be comprised of 5-wave structure. What we normally see is the wave 1 of that Roman numeral 3 will either target the 0.382 extension of Roman numerals wave 1 and 2, or the 618 extension. Once we see a 5-wave structure hitting those targets, we then wait for a corrective structure for the wave 2 of wave 3, and that is a natural entry point that gives you a natural stop at the Roman numeral 2 bottom. That is truly the ideal entry for most people that aren't hugely aggressive. People that are very aggressive are going to try and catch the turn at the bottom. But for people that have a little more patience, people that are willing to take 80% of the rally rather than 100% of the rally, that is probably the most natural entry point you can have. Any other questions? Yes, sir. Because it seems as though fear is a much more powerful emotion relative to greed. Greed is what pushes the market higher. Fear is what pushes the market lower. Fear is obviously a much more powerful emotion than greed. Any other questions? Yes, sir. We're looking for 2,200. Let me go back. There we go. We are looking for about 2,200 is the ideal target. 2,100 to 2,200 is the ideal target we have for that wave 4. From there, we're expecting a minimum rally to 32.25. The upper end of our target is at 4,011. I can't tell you which one is going to be the better target yet until waves 1 and 2 of that last 5th wave take shape. That's what I said. I'm an analyst, not a prophet. You know, we had a pattern we were following that if it had followed through, you could have hit 2,200 by the end of the first quarter of 2019. But that's looking a little less likely at this point in time. So, you know, it could continually meander for quite some time. It could take us as long as until 2020. So timing, I have never seen anybody that can identify timing in the market to anything greater than a 50% basis. So if you cannot identify something to greater than a 50% probability, to me that's almost useless. So I've never seen anything that can give you timing about how a market's going to move. For price targets, I've never seen anything better than Elliott Wave analysis for identifying price targets. But when it comes to timing, I can't tell you. Like I say, I'm an analyst, not a prophet. Yes, sir. The answer is, of course there is. Fourth waves traditionally will target the wave 4 of one lesser degree. That's a general expectation in Elliott wave theory. The fourth wave of one lesser degree is the bottom of that fourth wave box, which is around the 1800 region. So then the question I'm sure is running through your mind is, well, then why are you only looking for 2100 or 2200? When you have an extended fifth wave structure, in the third wave like we've had since 2016, your fourth wave will usually terminate at around the bottom of the second wave of that fifth wave extension. So my expectation is that that's where we're going to head for this fourth wave, which is about 2200. The traditional target is usually about 1800. So if we break 1800, we're screwed. No problem. Any other questions? Yes, ma'am. Okay, great question. The 2100 to 2200 retracement target that I have not only applies within the Elliott wave theory of coinciding with the second wave of the extended fifth wave, the 0.382 retracement of wave 3 is the common target for a fourth wave pullback. That 0.382 retracement coincides with the same region around that second wave pullback in the extended fifth. So we have confluence points of calculations that point us to that 2100 to 2200 region. So that's what we look for often. We look for multiple ways that we come up with the same answer utilizing various calculations. Now, when we begin the final C wave, now fourth waves or any corrective wave in an Elliott wave structure takes the form of an ABC structure. The most common relationship between an A wave and a C wave is usually 1-to-1. So once we see the A and B wave take shape, we'll be able to start identifying what is the most reasonable target for confluence for that C wave down. Now, within that C wave structure, and I'm getting really into the weeds here, so I apologize if I'm losing some people, but for those of you that understand Elliott wave, I'm getting a little bit into the weeds. The C wave itself is a 5-wave structure. Within that 5-wave structure, you then use your Fibonacci pinball to identify the extent of that 5-wave structure. So, for example, wave 1 and 2, when you calculate wave 1 and 2, and then you can calculate the whole progression of the coming 5-wave target, your fifth wave is usually the 2.0 extension of waves 1 and 2. So if we're looking for a C wave to come down, and we have that 1-2 of that C wave in place, we now can project where we expect that 5-wave structure to go. So we can now take the 5-wave structure projection for the C wave, the 0.382 retracement for the bigger wave 3. We could take that 2100 to 2200 region general target that we have. And then we can also look for what is the relationship between the A wave and C wave. And when we take all those calculations, we throw them into the vat, and then we see where is the greatest amount of confluence being presented, that is where we come up with a high probability target for where we believe this 4 will conclude. Right now, I'm giving you a theoretical target as to where I believe it will conclude. The more of the price structure takes place, and as the C wave down develops for that last move down towards that 2200 region, we can then identify a much more higher probability target for where this whole fourth wave correction will complete. Again, I'm sorry, I got into a little bit of the weeds there, but for those of you that understand Elliott wave, I'm hoping you were able to follow that. Well, if there are, yes. Yeah, absolutely. We use Fibonacci pinball for everything we do. Absolutely. And I thought I saw one question back there. Yes? I'm sorry? I personally, we have 16 analysts. I personally don't follow the NASDAQ. I personally follow I'll look at it every now and then, but I'm nowhere near as familiar with with these type of targets as I am with the S&P. The S&P is what I use for most of my work. So I apologize for that. Are there any other questions? And I thank you all very much for coming, and have a wonderful day.